Hello, savvy investors. Today we delve into the world of fundamental analysis. Fundamental analysis is an essential tool in the investor's toolbox, a compass guiding them towards profitable ventures and away from financial sinkholes. But what exactly is fundamental analysis? In essence, it's the practice of dissecting a company's financials to gauge its health and potential for growth. It's like being a doctor, examining a patient's vitals to diagnose their overall well-being. The importance of fundamental analysis can't be overstated, especially for those who are in it for the long haul. Investment is not a sprint, but a marathon. Quick wins might be tempting, but it's the long-term profitability that truly builds wealth. And that's where fundamental analysis shines, helping investors identify companies with strong potential for sustained growth. Now, the anatomy of fundamental analysis comprises several key components, each telling a different part of the company's story. Financial statements, for instance, are akin to a company's medical records. They reveal the financial health of a company, detailing its income, expenses, assets, and liabilities. Then we have financial ratios. These are the vital signs, the pulse rate, blood pressure, and respiratory rate of a company. They allow us to compare different companies in the same industry, helping us pick out the strongest contenders. Last but not least, we have economic indicators. These are the broader environmental factors that can impact a company's health. Think of it as the weather report, indicating the climate in which the company operates. It's also worth noting that fundamental analysis is not the same as technical analysis. While the latter is focused on price patterns and market trends, fundamental analysis is all about the intrinsic value of a company, its financial health and growth prospects. Now that we've laid the groundwork, it's time to take a closer look at how to select profitable companies using fundamental analysis. Selecting profitable companies is more than just a numbers game. True, financial statistics are important, but they're just one piece of a much larger puzzle. So, how do we put together this puzzle to reveal a potentially profitable investment? Firstly, we delve into the company's fundamentals. This involves analyzing elements such as earnings, revenues, assets, and liabilities. But it's not about looking at these figures in isolation. We need to understand how they've changed over time and how they compare to other companies in the same industry. For instance, if a company consistently shows a rising trend in earnings, it's a positive sign. However, if its competitors are growing at a faster rate, it might raise some red flags. Secondly, we need to do our homework on the industry and market conditions. Is the industry growing or shrinking? What are the key trends and challenges? How is the company positioned within the industry? A company might be doing well now, but if it's in a shrinking industry, its future might not be as bright. Next, we assess the company's financial health. This involves examining its balance sheet, income statement, and cash flow statement. We want to see a healthy balance of assets and liabilities, consistent profits, and strong cash flows. A company in good financial health is more likely to weather economic downturns and invest in growth opportunities. Speaking of growth, we also need to evaluate the company's growth potential. We look at factors like its investment in research and development, expansion plans, and market opportunities. A company with strong growth potential can generate higher returns in the long run. Finally, we consider the company's competitive advantage. What sets it apart from its competitors? It could be a unique product, a strong brand, superior technology, or cost efficiencies. A strong competitive advantage can help a company maintain or increase its market share. To illustrate, let's take the example of a tech company that has consistently increased its earnings, operates in a growing industry, has a healthy balance sheet, invests heavily in R&D, and holds a patent for a groundbreaking technology. This company checks all the boxes and could be a potentially profitable investment. Armed with these insights, you're well on your way to making informed investment decisions. But what tools can you use to make this process easier? Let's find out. The right tools can make all the difference in your investment journey. As we delve deeper into the world of fundamental analysis, it's essential to have a reliable toolkit at your disposal. Let's take a look at some of the resources that can make your life as an investor a little easier. First up, financial websites. These are a goldmine of data and a must-have resource for anyone serious about investing. Websites like Yahoo Finance, Google Finance, and Bloomberg offer a wealth of information. From the latest news and stock quotes to detailed financial reports and market analysis. They're your one-stop shop for all things finance. Next, we have financial databases. These usually require a subscription, but they offer in-depth information that's not readily available elsewhere. Databases like Morningstar Direct and FactSet provide comprehensive financial data, analytics, and research that can help you make informed investment decisions. Then there's financial software. These are specialized tools designed to help you analyze financial data. They can be a game changer, especially if you're dealing with a large amount of data. Software like Microsoft Excel, for instance, is a powerful tool for financial modeling and analysis. It allows you to crunch numbers, create charts, and run complex calculations with ease. Of course, having all these tools at your disposal is one thing, but knowing how to use them effectively is another. So, how do we interpret financial statements and reports? Financial statements are like a company's report card. They tell you how a company is performing financially. The income statement shows you the company's revenues and expenses. The balance sheet gives you a snapshot of the company's assets, liabilities, and shareholders' equity. The cash flow statement tells you where the company's cash is coming from and where it's going. Understanding these statements is key to evaluating a company's financial health. Look for trends in the data. Is revenue growing? Are expenses under control? Is the company generating positive cash flow? These are the kind of questions you should be asking. While these resources can be a big help, it's also crucial to be aware of common pitfalls to avoid. Even the most seasoned investors can make mistakes in their analysis. When it comes to fundamental analysis, there are a few common pitfalls that everyone should aim to sidestep. Firstly, it's easy to fall into the trap of only focusing on a company's financial performance. While this is certainly an important factor, it's not the only one. Other key elements such as industry conditions, market trends, and the company's competitive position also play significant roles. Another common mistake is to become overly attached to a single stock or company. Even if you believe in the company's potential, it's crucial to remember that all investments carry risk. This is where the principle of diversification comes into play. By spreading your investments across a variety of companies and sectors, you can mitigate potential losses while increasing your chances for overall portfolio growth. Then there's the pitfall of neglecting risk management. It's easy to get swept up in the excitement of a potentially lucrative investment, but without a solid risk management strategy, you're essentially gambling. Risk management involves setting a maximum amount you're willing to lose on an investment and sticking to it. A common misstep is also to ignore the macroeconomic environment. The performance of a company doesn't exist in a vacuum. Factors such as inflation rates, interest rates, and political stability can all impact a company's profitability and, consequently, its stock price. Finally, beware of confirmation bias. This is the tendency to seek out and give more weight to information that supports your pre-existing beliefs or hypotheses, while ignoring conflicting data. In the context of investing, this could mean ignoring negative information about a company because you're convinced it's a good investment. In conclusion, it's essential to approach fundamental analysis with a holistic view, taking into consideration not only a company's financials, but also broader industry and economic factors. Remember to diversify your portfolio, practice sound risk management, and be aware of your own cognitive biases. Remember, successful investing is not just about avoiding mistakes, but also about learning from them. So, we've covered a lot of ground today on fundamental analysis. We've journeyed through the intricate landscape of financial statements, ratios, and economic indicators. We've explored the key components that make up this critical tool for investors. We've discovered how to select profitable companies by evaluating their fundamentals, considering everything from their financial health to their competitive advantage. We've also delved into the vast pool of resources available for conducting fundamental analysis. From financial websites to databases and software, you now have the knowledge to access and interpret these tools to your advantage. And let's not forget the common pitfalls we've discussed. By understanding the mistakes to avoid, you're already a step ahead in your investment journey. Now it's time to put all this knowledge into action. Remember, knowledge is only power when it's applied. So, I encourage you to take what you've learned today and start integrating it into your investment strategies. Start looking at companies not just for their current value, but for their potential. Start using the tools at your disposal to make informed decisions. And most importantly, start managing your risk through diversification. I also invite you to engage with us. If you have questions or comments, don't hesitate to reach out. We're here to help you on your journey to becoming a more informed and successful investor. And remember, the journey doesn't end here. There's always more to learn in the world of finance and investing. So keep an open mind, stay curious, and continue to seek out knowledge. That's all for today, folks. Don't forget to subscribe to our channel for more insights on finance, investing, and wealth management. Stay informed, stay invested. This is your journey, and we're here to guide you every step of the way. Let's continue to learn, grow, and invest together.